All right, let's jump right into this. Welcome to today's Explainer, where we're unpacking a story of massive scale, intense global turmoil, and some seriously high-stakes financial strategy. We're looking at the first quarter 2026 results for TotalEnergies. Now, we live in a world where energy markets are incredibly sensitive, right? International conflict, supply chain issues, even the weather can send things spinning. Yet, right in the middle of all this chaos, TotalEnergies just reported a quarter that kind of redefines what corporate resilience actually looks like. So we're going to break down exactly how they managed to pull off this crazy high-wire balancing act and generate literal billions in profit along the way.
You know, TotalEnergies is often just viewed as this massive, faceless global energy brand. But when you look beneath the surface, it's really a machine that's been carefully engineered to absorb global shocks. Financial reports usually just look like dense, boring spreadsheets, but if you know how to read them, they actually tell a fascinating story. And this Q1 report, it isn't just a ledger. It's honestly a masterclass in how a diversified, integrated energy model can weather almost any storm the world decides to throw at it.
So, here's the roadmap for the Explainer today. First, strong Q1 2026 financials. Second, offsetting the Middle East conflict. Third, the integrated energy model. Fourth, tracking climate and emissions. And finally, number 5, shareholder returns and outlook.
Let's get into it with Section 1, strong Q1 2026 financials, a look at the top-line numbers.
I want you to just think about this number for a second. $5.4 billion. That is TotalEnergies' adjusted net income for just a single 3-month period, the first quarter of 2026. This is a massive 41% jump compared to the previous quarter. To put that into perspective for you, that's roughly $60 million in net income generated every single day of the quarter. It's an absolutely staggering amount of profit, especially when you factor in the incredibly complex global environment they're operating in. But you know, net income is really only part of the story here.
Because to truly understand the health of a giant company like this, you have to look at the cold, hard cash it generates. And here we're seeing $8.6 billion in cash flow from operations, excluding working capital. This immense liquidity, it's the absolute engine of the company. It's up 20% from the fourth quarter of 2025. This $8.6 billion is exactly what keeps their balance sheet rock solid, funds new multi-billion-dollar projects, and ultimately, as we're going to see a bit later, rewards the shareholders.
Moving on to Section 2, offsetting the Middle East conflict, the strategic pivot point.
Now, this is what brilliantly illustrates that balancing act I mentioned earlier. They took a very serious blow this quarter, a 4% production loss directly caused by conflict shutdowns in Qatar, Iraq, and the UAE. Now, for most companies, suddenly losing 15% of your total oil and gas production, which is about 360,000 barrels a day, that would be a devastating financial hit. But remarkably, at the exact same time, they managed a positive 4% organic production growth. How? Well, right as they were losing production in the Middle East, they had new project startups kicking into high gear in places like Brazil, the US, Denmark, Angola, and Libya. They perfectly offset the loss.
And this perfect equilibrium, it was definitely not a lucky accident. As CEO Patrick Pouyanné pointed out, this really demonstrates their ability to capture price upside through a highly diversified, integrated portfolio. By making sure they didn't have all their eggs in one geographic basket, they were able to absorb a major geopolitical shock and still come out delivering over $5 billion in profit. It's structural diversification at work, literally by design.
Which leads us to Section 3, the integrated energy model, where the money is actually made. When we break down that adjusted net operating income across their 4 main segments, it's pretty clear who's doing the heavy lifting. Exploration and production brought in a massive $2.57 billion. Refining and chemicals is also a huge contributor at $1.59 billion. Then you have integrated LNG bringing in $1.31 billion, and integrated power sitting at just over $500 million. What we're really seeing here is that traditional oil exploration and refining are the giant profit engines right now, and that cash is essentially funding their broader strategies and newer segments.
But the quarter-to-quarter momentum is what truly stands out to me. Exploration and production didn't just make money, it jumped 43% from the last quarter. This sharp rise fully reflects how sensitive the company is to rising average liquid prices, which, by the way, were up over $12 a barrel in the quarter, plus the added contribution of all those new projects we just talked about. Refining and chemicals also saw a massive 60% jump because they managed to capture some exceptional margins in March.
Then you've got the integrated LNG segment, which is its own fascinating story of capturing upside. They saw a 12% increase in liquefied natural gas production, driven by some really strong output from Australia, the US, and Malaysia.
On top of that, their trading arm was highly active, basically turning global market volatility into a highly lucrative advantage. This segment alone brought in $1.3 billion. And, super crucially for their future pipeline, they also announced the full restart of all activities at that massive Mozambique LNG project.
And that builds right into their integrated power segment, where we find yet another perfect internal balancing act. So Mother Nature delivered a really mild winter in Europe and the US, right? Normally, that means lower demand and a big drag on earnings for gas power plants. But at the exact same time, their power generation from renewables surged by 20%. They actually commissioned 8 gigawatts of new renewable capacity over the last 12 months, and that growth neatly offset the dip in gas-fired power. It kept the segment's income perfectly stable.
All right, moving to Section 4, Tracking Climate and Emissions, looking at environmental metrics and sustainability. Now, these numbers are highly significant. We are seeing a 33% year-over-year drop in methane emissions from operated facilities. That is a massive one-third reduction in just a single year. And right alongside that, overall Scope 1 and 2 emissions decreased by 6%. It's a really key takeaway for us today that while financial profits are skyrocketing and production is growing in new regions, the direct environmental impact metrics tied to those operated facilities are actually trending downward.
Digging just a bit deeper into that 6% drop in Scope 1 and 2 emissions, the report outlines exactly why this is happening. The decrease is directly tied to the company actively reducing flaring at their exploration and production sites. Plus, as we just noted, that super mild winter led to lower activity at their gas-fired power plants. Less gas burned for electricity directly and literally translates to lower immediate emissions on the ledger for this quarter.
Which brings us to our final section. Section 5, Shareholder Returns and Outlook. The payoff.
For the everyday retail investor, this is the crucial takeaway right here, 5.9%. Supported by that incredibly strong $8.6 billion in cash flow we talked about earlier, the board decided to increase the first interim dividend by 5.9%, taking it to 0.90 euros per share. According to TotalEnergies, this represents the highest dividend growth among all the oil and gas majors right now. It's basically a direct passing of that captured market upside straight into the pockets of the shareholders.
And the rewards don't just stop at the dividend. Looking ahead to the second quarter, the board authorized the continuation of share buybacks up to $1.5 billion. They've also confirmed they are keeping their objective of maintaining a payout ratio above 40% for the year. But honestly, what's truly remarkable is that they are doing all of this, paying out dividends and doing billions in buybacks while keeping a very healthy gearing ratio of 15.5%. And they manage this even with a $5.1 billion increase in working capital, which mostly just came down to seasonal business needs and higher hydrocarbon prices bumping up their inventory values. Their financial foundation is just rock solid.
So this really leads us to one ultimate question. We've just seen a masterful display of corporate agility in Q1, right? Offsetting a 4% conflict loss with a 4% growth gain, balancing gas dips with renewable surges, and somehow turning market volatility into $5.4 billion of pure net income. But with geopolitical tensions remaining sky-high and energy markets staying completely unpredictable, can TotalEnergies actually sustain this perfect balancing act through the rest of 2026? It's a fascinating narrative of resilience for sure, and one we are absolutely going to be watching closely in their next report. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.